Hello everyone and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into today's video. Okay, everyone, let's get started with today's episode of Buy, Sell, or Avoid. And in these videos, what I'm going to look at are some stocks within the S&P 500 index. So all the stocks that I'm considering will be in the S&P 500. One of them looks like a good relative buy compared to the index. Now, sometimes these relative buys might not produce great returns if the whole index is really high, but they should produce better returns than the index as a whole. So we're always looking in these type of videos for the best relative performers that I can find. If you'd like to know about the best absolute performers for all the stocks that I cover, including those that aren't in the S&P 500 index, then the Cyclical Investors Club premium service is what you're going to want to check out. So we're looking for the best relative returns we can get here. So that will be the stock that we'll focus on for our buying opportunity. And I'll also talk about a high quality stock. This week it'll be Nike that is high quality, but the price is high enough where if I owned it, I would sell it. I don't own it in this case, but if I did, I think the forward returns are going to be low enough that it would be worth taking profits in. And then the last stock we'll talk about, which is Franklin Resources this week, would be a stock that I would avoid. And I'll explain to you what I'm looking at and why I would avoid it. It doesn't necessarily mean it's bad. It doesn't guarantee the performance will be bad. But I have a series of factors that I look at where there's just a high probability that it will underperform in the future. So let's take a look at those three stocks. Okay, first we have Principle Financial Group. The ticker is PFG, okay? And we're looking at it on a fast graph here. So what fast graphs does is it tracks long-term earnings and PE ratios and price and things like that. So this shaded green area are the long-term adjusted earnings, EPS, so it's earnings per share. The white line is dividends. The black is price, okay? So usually when I first look at a stock, I like to just get a big picture of what it's done. And so this is a chart of the past 20 years. And the number one thing that I focus on is the fluctuation in earnings, okay? So, and we see that we definitely have some fluctuation here with Principle. And if you go down to the bottom, you can get more precise numbers. So earnings fell 9%, then 25%, then 3%. 3 years in a row they fell during the financial crisis in the 2008-2009 recession. Okay, so roughly looking at those, that's like a 35% or so decline from top to bottom in earnings. If I see this as less than 50%, then I don't consider this a cyclical stock. So I would consider this like a highly cyclical. I don't consider it a highly cyclical stock. I would call this a moderately cyclical stock. And the reason it's important to distinguish that is because if it's highly cyclical, I use a different type of analysis that I'm going to use here. Okay? So, but it's not highly cyclical, it's moderately cyclical. And during the current downturn and recession, we have a very similar moderate decline in earnings per share. So it's still fitting the pattern during this recession as it did during the last one, although I think this recession will be not as bad because this is a financial company and the financial crisis affected these financial companies a lot. The next thing that I want to do is figure out what time period that I think represents kind of what we could expect in the future. Okay, so, and for me, and I always want to include one recession. Now, it's not shaded here right now, but we're in recession right now in 2020. And we're expected to come out of it next year. And that makes sense to me. I agree with that basic assumption. So what I want to do is shorten this fast graph to a time period that I think represents kind of the earnings that we could expect, the earnings trend we could expect in the future. And for me, I think if we start this graph in 2015, we get a pretty good picture of what we might expect. We have 1 year with a little bit of earnings decline here, and then slow to moderate growth, we'll call it. And then we have a period of recession where earnings decline a little bit. This is important to me because when I calculate my earnings growth rate later, I include an assumption that it will experience these type of downturns in the future for the next recession, because I'm going to forecast forward 10 years and I'm going to assume we'll have at least one recession during that time period. So this captures a couple down years, which is good. It has pretty similar growth to what's expected once they have a rebound. So next year, this is what analysts think will happen, this dotted line. So analysts think earnings are going to go up to $6 per share. And then after that, the next year, they're looking at 9% growth, which is right in line with kind of what we saw here. So this all seems pretty logical to me and reasonable to assume. And that really, I'm just trying to make some reasonable assumptions, get a reasonable time frame to work in. Okay, so I have two main factors that I focus on when I have moderately cyclical stocks. One is what will happen if the PE ratio reverts to its average PE ratio over this time, and how much of a return could I get from that over the course of 10 years, okay? So right now we see on the fast graph, they're showing a blended PE of 10.27, and the normal PE during this period is 11.04, okay? I like to calculate my own PE because sometimes I like to look in the future and choose a PE after a recovery. So we're pretty confident. We don't know how much earnings will recover next year, but this is the estimate from the analysts that cover the company. So since I cover a lot of stocks and I don't know every company intimately, I rely on this sometimes to give me a guide of what might happen in the future. So FastGraph's PE blends kind of the current PE along with the next couple of quarters. What I'm going to do is I'm going to take this earnings number and create a PE using today's price of $49.61. And I have a spreadsheet that helps me do that. So when I do that, I get a full cycle, or a current PE, the full cycle average is 11.4. That's what's in the fast graph. The current PE, if we use next year's earnings, is 8.25. So we see there's a big difference between an 8.25 PE and 11.04 PE, okay? And what I'm measuring is what would happen if it just went to the average PE of 11.04 and it took 10 whole years to do that. If it does that, you'll collect 2.95% per year in returns. So that's how much, that's the CAGR, the compound annual growth rate you would receive per year if you held the stock for 10 years, and over that whole course of time, on year 10, it hit 11.04, okay? So usually this happens much quicker, within 2 or 3 years most of the time. So often this return is a lot faster and bigger, but I like to spread it out over 10 years just to make everything sort of uniform, okay? So this is the amount of long-term return I think I can get just from the mean reversion. Okay, now that's one component of what I'm trying to figure out. The next component is I like to know what sort of return I could get from the business's earnings if I just bought the whole business and I kept all those earnings for myself. So the way I do that is I figure out what the earnings yield is, okay? So if the fast graphs calculates theirs using their blended number, but I do it myself using my own number, and I get, let's see here. So I get, if you were to buy the whole company, here's the earnings yield, 12.11%, okay? If I was to buy this company for $100, it would pay me back $12.11 per year on my $100 investment. Okay? And what I want to know is how much of that money would I collect over the course of 10 years? Now, if the company didn't grow earnings at all, you would just multiply that number times 10, and it would be like 120 or something, plus your original $100. But since earnings are growing a little bit, we need to calculate that in. And I do that on the spreadsheet. I have a formula that calculates it, okay? But before we can do that, we need to figure out what the growth rate is per year. So that $12 should grow a little bit each year. Now, if you look at the fast graph, it gives you a growth rate of 5.07%. So that's how fast earnings have grown per year during this time period. And they're measuring from right here in early 2015 to right here in early 2021 now. Okay? So since I'm assuming that earnings are going to recover, what I actually want to measure from, and I want to include this recession, is how much would earnings grow from here to up here. I also like to adjust for any share buybacks that occur during this time, and I take into account these years where earnings fell. So I'm going to take into account the years where earnings didn't grow and they actually shrank. So the fast graph number doesn't do that. It's just kind of a straight up calculation. So when I do those, they bought back about 6% of their shares over this time period. I'll adjust for those shares that were taken out because that inflates the EPS. But I'm also going to assume that we recover one next year out of the recession. Okay, so usually when I compare my adjusted EPS growth rate to fast graphs, mine's usually lower. But in this case, because the fast graph is measuring right here, down here, they're using a number similar to this, and they're measuring it from here to there instead of up here. It creates a lower, slower growth rate. So ours are both pretty similar, but mine ended up being a slightly faster, about 6%, which is okay for a mature company. It's not super fast, but it's faster than inflation. So when I run the calculation and I say, okay, look, I bought this whole company for $100. It pays me back $12.11 per year, and that $12 per year is going to grow at about 6% here. I want to know how much money I'll collect after 10 years, including my $100. And that works out to about $268.69, okay? So I say that's how much money I turned my $100 into after 10 years. And then what I do is I convert that into a CAGR, so a compound annual growth rate. And that comes out to about 10.39% using these assumptions. The big assumptions here are obviously earnings recover next year and they grow close to that 6% rate. If we get those two things that happen, the business is going to return a lot of earnings. All right. And ultimately what I want to do is know what type of return I'll have if I combine the mean reversion, which is dependent on the market treating this as it has in the past, and the business return, which is how much money the company is likely to earn. When I combine those together, it's just adding these two numbers together. I get a 10-year CAGR expectation, 13.34%. My general guidelines for buying moderately cyclical, high-quality stocks like this is a 12% CAGR per year. So this is over 12%, and I would consider it a buy right now, especially relative to the S&P 500 index. Even not relative, over 12% is a buy for me. So additionally, I included a PEG ratio using my adjusted numbers, and we can see that it's relatively low. The whole index is above 3 right now. So lower PEG ratio, if you're not familiar with it, is better. Back in the old days, we used to say like a PEG of 1 or lower was a good value. Nowadays, with low interest rates, 1.5 below that is probably reasonable value today. Okay, so I have several other things. All this looks very good for the company. I have several other things that I check in order just to see if it might be a value trap. One of those is the 3-year revenue trend. So what this does is it looks at how much revenue grew or shrank over a 3-year period leading up to the current recession. So we expect revenue to decline during the recession, but so we don't want to measure it necessarily down to the recession bottom, because I assume there'll be a recovery. But what I want to know is, was anything going on before the recession when things should have been going well? Were revenues weak leading up to it? And that 3-year period is enough to usually work out any one-time issues that they might be having. So leading up to the recession in March, Principle's 3-year revenue was about 12.54%, which is fine. This is just a weed out thing. It's not really how much the revenue grew. It's mostly whether it's positive or negative. Sometimes if it's pretty slow, like low single digits, that can be a warning sign too. But when it's negative, that's when I would say, okay, the numbers look good, but it looks like their business is probably not going to do as well this next cycle as it did the last cycle. That's really what I'm testing for here. Now, the one warning that I would have about Principle is that its recession PE is a lot lower than the current price. And this is why I recently bought this stock, but I didn't buy it back in March, because I'll show you on the fast graph here. So if we go back to the last recession, which is what I had to work with leading into March, the PE that it bottomed at was like a 2 or a 3 down here, okay? Because the market knew that this was going to be bad for them, right? It knew ahead of time. So it baked in that pretty early. So if we had another recession, or the recession we have gets worse, we have a double dip or something like that, and it's similar to the last recession, then the stock price could fall 60% just based on that alone. Now, I think this is extraordinarily low given that they were directly affected in the last recession. It looks like this COVID recession is coming to an end with the vaccines and so forth. So the reason I'm buying it now is because it looks like there's a light at the end of the tunnel for the current recession. And it looks like this really deep danger of a 60% decline is off the table. So I'm assuming that this doesn't happen, but that would be the biggest danger buying this stock. Okay. And then the last factor is, this is just something I like to just keep an eye on. So this is the shareholder kind of capital allocation. And all it is how much of earnings is the company returning to shareholders, either in buybacks or in dividends. And about half right now is what Principle is returning to shareholders. And what I really like to compare this to is the growth rate, to see if it makes sense. If a company is growing really slowly, okay, I want this number to be very high. If I was to put like a tobacco company on here, it would be 90% or something close to that. Okay, they're basically returning all their money to shareholders. Principle is only returning about half, but they are growing at a reasonable rate. So that's fair to me. Okay, really, I'm just looking for things that are out of the ordinary here. So they're going to return some money in buybacks. The stock has a pretty healthy dividend yield, 4.52%. So the money they are making, they're returning a decent amount of it to shareholders. So this would be my first kind of best relative buy in the S&P 500 right now. Next, let's move on to a stock I would take profits in if I owned it, and that's Nike. Okay, so we're going to basically do the same process for it, and I'll show you my thinking behind this. Okay, Nike is a high quality stock, all right, but the price has simply gotten so expensive that your future returns are likely to be low. Okay, so that's what I'm going to explain here. Now look at this very steady earnings growth, and then earnings level off. Okay, and then during this current recession, earnings dropped, and now they're recovering. Okay, they're already starting to recover, and they're expected to recover even higher. All right, but what's happened with the prices, even though earnings haven't taken their previous trajectory, leveling off, going down, maybe now they're just starting to rise. This entire time, the price is, which is the black line, has gone nothing but up. Okay, so now we need to think about what time frame we should look at here. And I did some thinking on this already, so let's see what I decided when I was doing this. I went with 2013. I thought seemed like a good year to start. So let's adjust the fast graph to 2013. Okay. So, and this looks pretty fair. We're getting low double digit or to mid double digit earnings growth for a few years, some kind of choppy growth here or no growth, a down year because of recession, and then a recovery is expected. And then next year we're back to kind of where we were over in here. All right, these kind of mid-teens to 20% growth once the recovery happens. And I think a lot of this has to do with some transformation into digital selling and online selling, direct selling. And part of that anticipation is baked into Nike's price. So I think some of that is perhaps justified if they can start growing at 20%. But that's speculation right now. So what I'm going to do is I'm going to bake in some of that speculation, and I'm going to use 2022's earnings. So we're going to assume they fully recover this year and grow a little, and then they grow another 28%. And so I'm going to be, since I think this is going to be a bearish conclusion, I want to be really generous with my assumptions. So I'm going to assume that they're successful in improving their earnings in the next year. Very successful. This would be faster in any normal year than they've grown earnings in the past decade. So that's a very generous assumption, and that's what we'll use here. Okay, so I'm going to go through the same process that I did before. The normal PE during this time was 26. Right now the PE is 58, but I'm going to use these earnings, so that's going to lower their PE down a little bit. So let's take a look at what I have here. So this is their long-term average, and I have, instead of 58, if we use their future earnings estimates, currently they're only trading 30s are high PE, but compared to 58, it's really only about 37. So it is expensive relative to the past, but it's not as expensive as it initially looks if you just use the current earnings or even the blended earning. So, but still, if it reverts to the mean, if it goes from 37 to 27 and everything else stays the same, you're still going to lose 3.27% each year for 10 years just on that mean reversion. Okay? So that's not usually what I want to see when I go to invest. So the stock price is just getting a little ahead of itself. So it's a situation where they can be successful, but you can still lose money just if the market changes its mind a little bit. Okay? So next I want to calculate the earnings growth rate during this period. So they bought back about 12% of their stock since 2013. Okay? And the fast graphs estimate for earnings growth is 13% over this time, or they're measuring it as 13%. My estimate, once we take into account this decline and these flat periods, okay, and we take into account they bought back 12% of their stock, my earnings growth estimate is much lower at 8%, 8.01%. So I'm not expecting them to grow as fast as most people, I think, for sure. And there is a difference between this, and remember, I'm measuring from here. I'm assuming that they get all this growth. So I'm baking in 1 year of 28% growth. And what my debate is whether this year is going to be 18% on average every year forever for the next 9 years, or whether it will be more like 8% once we include drawdowns and so forth. So that's the big difference that I have with the market right here. I'm saying 8% long term, and they're saying 18, roughly. So when we use that growth rate, and we have an earnings yield that we start with of, let's see what it is here. Earnings yield, you can see the difference between Principle, which was 12.11%, and Nike, which is 2.71%. So if you bought the company for $100, the company would earn in earnings $2.71 per year, and that $2.71 per year would grow at 8% if my estimates are close. Okay, so if that happens over the course of 10 years, you'll turn your $100 into $142.38, and the total CAGR for that time period, 10-year time period, is 3.6%. So that's what you would earn from just the business with those assumptions. Now, if you think the company is going to grow much faster than 8%, that number is going to go up a little bit. I mean, I can show you right now. Actually, we'll just type in, what do you, if you think it's going to grow 15%, then we'd be up to 5%. But it's not really moving that much, even with a bigger growth rate, because the stock is so expensive right now. Okay? So, probably going to get about 3 to 4% from the business, but if the mean reverts, so if you can imagine the stock, if the company grows at 8% a year after the next, starting in 2023, eventually the market's not going to be pricing in a 37 multiple, okay? 8% growth is a lower multiple, and it's probably more like something like their average, like 26 or 27. So it would be reasonable, if this growth rate plays out, that the mean would revert, okay? And so what that's going to leave you is, if you combine the two together, you're looking at basically a flat return for 10 years. So you're not going to do bad. It's a high quality company, but the stock is expensive, so your likely returns are not going to be that high. And when you could sell something like this and buy something like Principle that's returning potentially returning 13%, that's a good thing to do. So Nike would be my sell for this week in the S&P 500. Now let's move on to a stock I would avoid in the S&P 500. Okay, now we have it used to be Ben Franklin Resources. That's why it's called Ben. Franklin Resources. And again, we have a pretty decent quality business historically. I mean, you can look at this great growth rate. It has been almost a cyclical, so it's moderately cyclical. We have a drawdown of like in between 40 and 50% during the last recession, okay? But what we have, and we can just see it on this, let's see if I can get this to go away. We can see it on this chart, is even though the economy was growing, back in about 2015, earnings started declining for these guys, okay? And the general trend is that they've continued to decline. And so that's a warning sign that they could be being disrupted. I suspect that things like ETFs and indexing and things like that have affected their business. But I don't usually dig deeply into these companies. I mostly look at what the trends are and what the numbers are showing me, so that I can look at a lot of companies quickly and make decisions. So that kind of tips me off right there that there could be something going on. But what I want to do is, let's frame this. See how I decided to frame this one. 2012. Okay. So let's start the cycle in 2012. And basically what that does is it gets rid of the big giant dip during the last recession, because we're in a recession right now. So I'm including the recession now, but I'm getting rid of the last one. So this is what it looks like here. And now again, we see this not sharp downtrend, but we see a gradual loss of earnings power, okay? And that's something to pay attention to. Now the normal PE is 12.44 during this time, all right? So, and the current PE is only 8.93. So you would get a good return from this investment if the PE reverted back to the old PE. But that's going to be difficult to do unless they can grow earnings. So now it's actually a little worse than what it looks like on the fast graph, because the fast graph is in earnings per share. So if you have a company that buys back a lot of shares, it raises the EPS that they're earning, the earnings per share, because the share is getting lower. And that's what they've been doing. They bought back about 21% of the company during this time period. And so when you adjust for that, this gradual slope that we see here of earnings issues is actually much steeper once we adjust for those buybacks. And so when I do my calculation, taking that into account, I actually get a negative growth rate, a pretty substantial negative growth rate during this time period. Fast graphs, if you just use theirs, is basically flat. But when I count these buybacks in, then it goes almost 4% per year. They're earning less each year, less and less each year. So their earnings are actually shrinking. So when I do the rest of these calculations, now shrinking earnings are basically enough to get me not to buy the stock. So I don't even really need to get into the rest of this. But because I don't buy companies where earnings are shrinking, you can make money on them if you buy them cheap enough sometimes, but that's just not my preferred way. I want companies that are at least growing earnings at the rate of inflation most of the time. Also, and you can see they have a negative PEG ratio, but the quick factor that you can check that really shows what's going on is this is leading into the recession. So during the course of 3 years, revenue fell 11.5%. That's very much in line with what we see with earnings. So that kind of shows you that my earnings estimate here is probably pretty realistic, because this isn't 3 years per year. This is 3 years cumulative. So if you divided that by 3, you're getting something close to what this is, which is per year. So that growth rate's per year. So their revenues are falling, and I would just avoid the stock because they're probably getting disrupted. Now, a really deep value investor might dig in at some point, but that's why I would avoid it. And this is a very effective way of avoiding value traps. This actually would have been triggered. My avoidance would have been. I recently wrote an article where I included Franklin as an example. It would have been triggered somewhere in here, I think. And so when this looked kind of interesting right here, it looked kind of cheap, it would have said, no, now's the time to get out. And then you can see what happened since then. You know, you would have lost 25%. And that's when the market has risen, I don't know, 50, 100% maybe since then, close to it. So it's pretty effective at avoiding these type of value traps. All right, so those are the three: a buy, a sell if you own it, and an avoid because of the 3-year revenue trend. And I'm going to put these in a spreadsheet, and we'll track the performance relative to the S&P 500 going forward. I recorded this on January 2nd, 2021. Thanks for watching the Cyclical Investors Club. Don't forget to like and subscribe if you found this useful. Drop a comment. I usually answer them. And if you have any requests from the S&P 500 index, I'll be glad to include those in future videos. Thanks for watching. Bye-bye.